Well, we had some economic data that came out at 8:30 that spooked the markets. One was Empire Manufacturing. It came in worse than expected. It was a negative reading. But I don't want to forget the CPI numbers as well, because they came in a bit hotter than expected. We saw the CPI, the headline CPI rise 0.2%, and that basically came in at the highest level since October 2008. Also, the core was the highest level. Is the highest level since October 2010. I'm trying to get these levels here. I want to bring in John Ryding, who we've talked to for several months on inflation and how the Fed is not watching inflation enough. And John, as I'm looking at these numbers, I'm wondering whether or not we're entering a period of stagflation here.
Well, that is a word that springs to mind when you see the economy slowing and inflation picking up. And of course, the Fed, not only the Fed, but other central banks want to blame commodity prices because it's sort of convenient. It seems to, it's something from outside, but commodity prices aren't from outside. They're created by the global liquidity situation. And the primary driver of that is Federal Reserve monetary policy. So the Fed has had this narrow focus that the labor market slack, the high unemployment rate would.
That we haven't seen the wage pressures, is what you're saying, right?
We have not seen the wage pressures. This is not a 1970s wage price spiral, at least at this stage, or perhaps I should more accurately say, at least not a wage price spiral within the U.S. But the big manufacturing area of the world now is China, and we've seen very big wage increases out of China. We had a reading yesterday on Chinese CPI that came out at 5.5%, which is headed higher. Perhaps, history doesn't repeat, it rhymes, so we shouldn't perhaps be looking for a wage price spiral in the US, and we shouldn't be taking comfort from the fact that it isn't there. Inflation can come from many sources, but the ultimate source, I think, is the ease of Fed policy.
Well, and as you and I were on May 18th when we had James Bullard on, and he was talking about how the Fed starts to lose credibility in some ways if it keeps focusing on core inflation. And as we are clearly seeing now, that is wrong, right?
Well,
in your view,
he was very good on that. That said that ultimately it's the broader inflation rate. So what happened? CPI goes from 3.2% year over year to 3.6% year over year, and it's been running at a much faster rate since November of last year when the inflation rate picked up. But what he was not so good on was when you asked him, at my point, on commodity prices.
Right.
Are commodity prices being driven by monetary policy? I said, it's very complex. We've got all these different things in these different markets. But the thing is, it's like an orchestra. I describe to people. You may have a woodwind section and a violin section and an oboe, and they may have different scores, but they got the same conductor. And all of these commodity markets have individual factors, but nevertheless, underlying it all, there's a sort of consistent beat that's being conducted by monetary policy, and it has created liquidity conditions, and therefore, it's because of the weak economy, the Fed looks to be on perma hold. And no taking out of the liquidity from QE2. Why should those commodity prices retreat? Why should we not have continued upward pressure on inflation, or at least inflation that's higher than the Fed's comfortable with?
Well, as we were talking about earlier, Federal Reserve officials are discussing whether to adopt an explicit target for inflation, a strategy long advocated by Chairman Ben Bernanke. It's a story that's exclusive here on Bloomberg. For more, I'm joined again by John Ryding. He's the chief economist and also the co-founder of RDQ Economics. And with me as well as Dominic and Mike McKee. And John, earlier we were talking about whether or not inflation is getting hotter here. So is inflation targeting perhaps the right move?
Well, inflation targeting might be the right move if you could change two things, one of which is the rules of the game under which the Fed operate. Because remember, they have a dual mandate. So if you give them an inflation target and an unemployment target, what do they do when unemployment's too high and inflation's going up? So that doesn't resolve the issue. It's not like the ECB. It's not like they work under a single mandate. And secondly, I think you really need to change some thinking about how inflation is created at the Fed, because if inflation targeting simply means the Fed will then run tight monetary policy in response to higher inflation, because they're trying to target the economy and target unemployment, then that's an issue. I think the Fed really needs to start thinking about price level targeting, looking at commodity prices and looking at some other guides for guiding policy much earlier in the economic
John,
cycle.
Betty, I mean, guys,
Betty, we've got some breaking news here. I don't want to interrupt you, Don, but industrial production numbers just out from the Federal Reserve, not going to add to the happiness on Wall Street. Comes in lower than expected, up just a tenth. The forecast was for a 0.2 gain. It looks like what it was this month was a utility story. Manufacturing did rise on the month, 0.4. After a big drop last month, everybody attributed that to Japan. And mining was up at a healthy pace, but utilities dropped 2.8%, in part probably because of the weather, kind of a cool month. And also, if you're using less electricity to manufacture, production is going to be down a little bit. So overall, not a particularly good story for manufacturing. Capacity in use unchanged. At least, John, that's not an inflation problem.
Yeah. Well, but I don't think it's too bad here with that manufacturing number coming in at 0.4%, because utilities are primarily driven by the weather. I mean, I hate to think what utility usage was in New York last week when the temperature spiked to 100 degrees, right? So we're going to have utilities output bounce back. But I really want to break this disassociation between inflation and economic growth as being somehow opposites. If the economy is too strong, that's when we get inflation. We have, as you asked me earlier, the makings of a stagflation problem. And inflation targeting doesn't solve that. It requires a kind of, it may give us clarity. And I'd love to see the Fed at least move away from the focus on the core perhaps not by some of Fed President Bullard when you chatted to him, but at least a lot of other people at the Fed hide behind this core notion and dismiss a 3.6% CPI year over year.
Well, one of the core issues, the reason why they don't look at core, they say, is because core is volatile in the short term, right? So here's the question. Mike McKee and I were talking about this earlier. Is there a time, let's say they do target inflation. What kind of inflation time frame are we talking about? Is it like in the next month or two inflation numbers, or is it more over 6 months or a year? Is that the real issue behind inflation targeting?
Well, if you target inflation, you have to do it over a significant time frame. You can't possibly target month-to-month numbers or even quarter-to-quarter inflation numbers. Monetary policy works with a lag, and you might be talking, I mean, a lag of well over a year in terms of changing monetary policy and influencing inflation. But inflation targeting is kind of like an insurance policy. It's like when Fed credibility is high, you don't need an inflation target, right? When there's no fire near your house, you may not need that fire insurance. When the fire gets close, you want it, but then it's expensive. So when Fed credibility starts going down, does inflation target restore that credibility, or is it too late at that point?
But there's one other goal, don't you think, of the Fed, which, you know, is not exactly in their mandate, but they want to see equity prices continue to rise, right?
Well, you know, that's a problem that goes all the way back to Greenspan and this notion of a Greenspan put. And it was actually a question that was asked that's so investors' mind. I was in Europe last week, and I got asked multiple times in different meetings with European investors in the U.S. market. Well, if the market goes down 10 to 15%, surely Bernanke will give us QE3.
Right.
And so you start getting that moral hazard notion. That's not good for markets.
That gets dangerous. John, thank you for sticking around. Really appreciate it. John Ryding of RDQ.